Hi guys, good evening and welcome to our latest episode of Between the Spreadsheets. I'm Stephen Englander, and in the studio today I've got my old friend of 40 years, wow, Simon Rothman. Simon's
Hello.
going to be talking to us today about the stock market and the commodities markets and all sorts of things that I don't know about, because people think that even though I'm an accountant, well, because I'm an accountant, I know all about the stock market and I know bugger all. You know, the only time I went on the stock market, I lost £1,500 and I've never gone on it again.
Well,
But
you were lucky.
I was lucky not to go on it again. Yeah. But you were telling me the other day about gold. Well, it's been very steady in its investment base.
I wouldn't say it's been steady. Gold is volatile, like many other commodities and like many shares. It tends to be used in times of crisis. That's when the price tends to move upwards. When there's situations going on in the economy, like the current situation, there's a lot of fear out there. So with the virus, etc. So when there's times of great fear, people tend to move into gold. Traditionally, it sometimes is thought of as a hedge against inflation, but I believe that the actual statistics don't back that up. So I don't believe it does actually maintain its value necessarily in inflationary times, but it is certainly a hedge against uncertainty. And as a cause of what's been going on at the moment, we've got obviously the pandemic situation. We've got the situation with the quantitative easing, a huge amount of money being pumped into the economies of the world. So that could theoretically devalue the dollar, and gold is valued in dollars. So, or should I say priced in dollars.
So are we going to get rich in investing in gold?
Well, that's the $64 million question. Certainly, gold has had a big move upwards in the last 3 to 6 months. It is at a record all-time high in nominal terms, but not accounting for inflation.
Would you invest in gold as a regular way of giving yourself an income?
It's not it doesn't. You can't derive an income from gold. It has no yield.
So it's just a place to put money against.
For example, a share, you can receive a dividend, a distribution of profits. If you've got money in the bank, you can receive interest. Not at the moment. The interest rates are very low. So gold will not provide an income. The reasons for holding gold would be to hopefully to make a gain on the cost of the gold. So if you buy it at $1,500 an ounce and you sell it at $2,000 an ounce, then you've made a profit.
But is that likely?
Well, it certainly has occurred this year. The gold price this year has been trading as low as $1,400 an ounce. It's currently up to almost $2,000 an ounce. Like I said, it's beaten the 2011 record high in nominal terms, not accounting for inflation. So accounting for inflation, it would actually be higher.
But you were telling me the other day, just coming away from gold, I know you were telling me the other day, because I always find it quite interesting, even though I don't know much about the marketplace. You were talking about how the American giants like Apple have really bucked the trends and are doing phenomenally well, because you predicted that when you thought they might drop, so you sold some and then they've gone up.
It's all about valuation. So they've been referred to as the stay-at-home shares. We're talking about the big 4 or 5 companies. So we're talking Apple, Alphabet, which is Google, Amazon, and Microsoft. So those are the real big 4. Now they've done very well before the pandemic, but they've done even better after the pandemic because, like I said, they stay at home. So the business is only going up with people working from home.
Right.
So they have done tremendously well. The point you made about me possibly betting against Apple was that it's all about valuations. So there's some crazy valuations out there for these shares. And the profits, the big 3 or 4 announced profits last week, I think Microsoft was the week before. Now, even though Microsoft had done phenomenally well when they announced the profits, the shares actually backtracked a little bit.
Yeah.
Because it was all in the share price already.
It's funny, the stock market, and I think this is one of the reasons why I think accountants don't always make great investors, because it's not always the increase in value of a share is not always linked to its profitability or its past profitability, and that confused me for many years. That
it confuses a lot of people.
Yeah, but sometimes it's I remember when mobile phones were first in place, I think it took 18 years or something for any one of them to make a profit, and many of them went into liquidation or were taken over. But all along the way, the share prices were going up and up and up. Yeah, I think does that sometimes create a bubble where it suddenly bursts?
Well, there's a lot of different ways of valuing shares, and there's all different approaches to it. So there might be value investing, for example. But
value investing is what?
That's where the company is producing quite considerable profits relative to its market value, indicated by the share price.
Yeah.
So you might be looking at, traditionally, not so much now because they're really suffering, but say the big oil companies, they would trade at lowish multiples to earnings.
That's just not very secure.
It's not very well. It's about future growth, really. Yeah. So it's not just present day value. It's not present day profits, but it's what the market anticipates will happen in the future.
Well, this is what happens with small firms. So everyone take note. A company is often valued on what the assets are, or what sort of profit they're producing. But the profit being produced is more, say, can I get finance on this, or can it give me an income? Whereas what a lot of people do is they buy potential.
Well, they buy future cash flow.
That's right.
I mean, there's various accounting discounted cash flow models and things which we won't get into.
Yeah, but future cash flow, future profits are what the big firms describe. But when we deal with a small firm, we're looking at the potential in the business, and often that potential, the greatest single factor that can change that potential up or down, is what the owners can bring to the table. So this is a little bit different, because but I've also noticed that sometimes when there's ownership change or new directors appointed in some of these big firms, especially when they're struggling, you can see a sudden improvement in value. On the other hand, you can see sometimes when there is change of management, especially when a company's stable, you can see suddenly people panic and start selling the shares. So there's often a decrease in value. Is that quite common on the stock market?
Well, I mean, there's certainly, change in management can have an effect. Sometimes bad management brings the company's profits down and the share prices down. Some people, that could be perceived as a good opportunity to buy the shares because a new management might increase the profits.
Yeah.
But equally, they could keep dragging the company down even further. So that would be considered maybe a value trap.
But sometimes the director might turn around in the public and say, "My stock is crap. We deal in crap." Well, that doesn't help, does it?
Well, you say it doesn't help. I think the example you're referring to is the Rothman one. Is that a similar one? But there's an example at the moment. There's a company called Tesla, which I'm sure you've heard of.
Yeah.
And their owner, MD or major shareholder, is perceived as being a visionary, an incredibly intelligent man. The share price has gone absolutely through the roof. I'm not suggesting you should buy the shares. The share price has gone up, say, 500% this year, or in the last 12 months. And it's all about future profits. It's all about what they think the company's going to do. But he actually came out about 3 months ago and said, my company's shares are overvalued.
Yeah. But is it a case of
got them keep going up?
Yeah. Is it like he's so charismatic and has such a wonderful hardcore following?
Yes.
That people buy into the company just
He's got a huge following. He's got a huge following, and the share price just keeps getting pumped up and up and up and up. The company valuation is going higher and higher. It's got no relationship whatsoever to the profits that it makes.
Yeah. So really, when we think about it, if people tune into you and we do these daily updates of the stock market that you're
Yeah.
talking about, you could have a massive following, and people buy into you and your quirky ways, and just follow you.
Well,
But you never
I
know,
think
do you?
I need to produce a little bit more than that, maybe.
Yeah, because I mean, this type of following is a big cry for when you used to be a model, isn't it? But we
That's
won't
right.
talk about your modeling days. We'll just carry on with this.
Yeah.
What I found interesting is with you explained to me, because I'm not a big football fan,
Mhm.
and I don't really understand football. And I remember I'm saying I had the most interesting conversation with you that I've ever had with football, because you're explaining to me about how it really works as far as the funding and the stock market and everything else goes with it. Do you remember that conversation?
But I have vague memories of it.
Okay, you started telling me about what was that multi-millionaire that's financing one of the football teams?
Well, they're all multi-million. Well, nowadays they tend to be billionaires
Yeah,
that are financing football teams. So
yeah,
you have the Saudis and the various Arab corporations that have ownership of football clubs at the
yeah.
moment.
So why can't we compete with that? I mean,
We being who?
well, let's say I'm a multi-millionaire and I
Yes.
decide I want to go and buy a football club.
Yes.
So I'm going to pump millions of pounds into
Well,
it.
like I said, these days, depending on the club you want, you'll need more than multi-millions
Right.
because, especially if you're looking at clubs in the Premier League.
Yeah.
I think one is in the process of being sold at the moment. I'm not sure if it's going ahead. Newcastle United.
So
And
how do I make money out of buying Newcastle United?
oh, I have no idea. I couldn't tell you that. No,
But the
I mean, I don't even
Saudis,
know if it's traded as a. I don't think it's publicly traded. Number one.
but the Saudi government
Yeah,
are
right.
behind Manchester City, aren't they?
No, the Saudis are behind. I think it's possibly PSG. I think it's the Abu Dhabi or United Emirates, which is somebody can correct me on this.
Yeah.
That's behind Manchester City.
So they have another agenda, don't they? They don't need it to be profitable, because what are
No,
they
no,
trying to
it doesn't
achieve?
appear to be. Just for comparison, the owners of Manchester United are American businessmen, and they do need to make a profit. They're
Yeah.
repaying loans to finance their purchase, whereas the owners of Manchester City appear to be sovereign wealth fund, and it's about promoting, I believe, their own agendas or countries.
As a country.
Yeah.
So it just shows you again that the stock markets, that big business, big money, isn't always about making a profit, which is what we all think.
Well, but I'd like to. The point with the football clubs is I'm not sure. Possibly United, but I don't believe Manchester City are traded on the stock market anyway. So you wouldn't have the ability to buy and sell the shares anyway. It's privately owned, as far as I'm aware.
Yeah. No, the point that I think what I was sort of clumsily trying to say was that when it comes to big business, big money, it's not always about the profit element. And when you go and buy shares and you go and try and invest in gold, and there's other things going on. I think that's really what I'm saying.
I'm sure. I think in some circumstances they might be.
Yeah,
But
that's it. But you never know.
You never know what's going on behind the scenes. But I think ultimately, in terms of commodities and shares,
Yeah.
I mean, the owner of the business might be just trying to grow the business, but the shareholders obviously want to see the profits. They want to see the rise in the share price.
Yeah. But all this makes it hard to predict. And I think going back to why accountants don't always make good advisors on the stock market is because there's other things going along other than just
Sure, because as an accountant, the first thing you'll do is you'll look at the balance sheet.
Yeah.
And possibly the profit and loss account, the cash flow statement.
Yeah.
And that's all relevant, but it's not the full story.
No.
And for some companies, it's more or less important than for other companies. So, like I said, to use the example maybe of Netflix, Netflix is a huge company. It's absolutely massive. I'm not even sure it even makes any profits anymore. Any profit at all. I'm not even sure if it's gone into profit. They tend to value it on how many new subscribers they're getting. And the valuation of the company is in the hundreds of billions.
But it's difficult to know. unless you really study and even then sometimes it's putting a pin in things, isn't it?
Oh, I think so. I think they did an experiment many years ago where they suggested you get a monkey and they put a pin in the share prices of the Financial Times, and the monkey did as well as the professional advisors.
Yeah. But
Um,
being where we are, I'm often looking for ways that small businesses can gain. So the point of having a show, and even a regular show, about how the stock market is doing is because it does sometimes and quite often give people an insight into how the world operates. And the more I think small businesses are aware of what goes on around them and in the real world, the better decisions they can make in their own business. So there's also the possibility that we get the odd gem out there that could actually float and become a publicly traded company in their own right.
Yeah.
We've seen that happen a few times with people we know. There's a lot of scope these days for, if you've got a good idea and a good process, there are a lot of people out there looking to back potential, what do they call them, unicorns. That's more techie, isn't it?
Is that a techie one?
Is that so?
I don't know. I'm not really a tech person.
No. It's a unicorn is basically a business that goes into riches very, very quickly, and it's often in the fintech area, the high tech,
Right.
and all these it's basically a startup that's sort of massive. So these are the exciting things to understand, that you don't actually have to understand the stock market to look at your business as a potential candidate to float, to become a PLC company, and you don't actually have to be floated to be a PLC. You can set up a PLC company, you can turn into a PLC company for a few £100s. So that in its own right gives people some prestige as well. So you as long as you're not, you only need to float if you want to offer your shares out. But then you've got three main exchanges anyway.
Sure.
You've got the main London Stock Exchange, which is the biggie, and then you've got AIMS, which is for most companies looking to float, and then you've got what's the last one? Next, isn't it? The Next exchange, which the new exchange, which is for anybody can join that as long as you fit a few criteria. I mean, I've seen your local hotels floating on that one. But no, it's interesting. I think in days gone by, people used to call them penny shares, and when people have this sort of investment mentality, I mean, you can look at crowdfunding now as well, because that's got the same mentality as the stock market, except people are just giving money away from that.
Yeah.
I'm surprised you're not on that, Sam. Please. I'm going on it.
I saw someone on it the other day crowdfunding. They'd seen a house they wanted for £2 million, and they didn't have any money, so they were asking everybody for £1.
Wow! How did they do?
Well, I think they had 3 offers when of
what,
£1.
for £3? Oh well, it's £3. Yeah. No, I see a lot of that. But I know. Just going back to the stock market, when the virus first broke out, you were concerned about some investments you had in some shipping companies, in some cruise companies.
No, basically, I didn't own any shares in cruise companies. They did very badly when it all came out with the ceasing the cruises and all sorts. And there came a point at which it looked like it was an opportunity to buy shares in the one with a strong balance sheet. Because at the end of the day, we all expect things to get back to normal in 6 months, 12 months, or whenever it is. But some of these companies that can't trade at the moment, the hotels, the cruise liners, the airliners, the question is, when we come out of the virus, whether their balance sheet is going to stack up, whether they're still going to be in business, because their monthly expenses are going to get eaten up. So there was a cruise company that had a particularly strong balance sheet. I thought that might be an opportunity, but it's one of those examples of getting in a bit too early. So although the price was 2/3 down on what it was, or half of what it was, it still carried on falling. Fortunately, there was a bounce and I managed to get out again, and then it's gone back down again. So that was quite lucky.
I suppose one of the things about looking at an asset base is that there's a convention in accounting that assumes that the business is going to continue. So if a business continues, the assets are worth X,
Yes.
but if the company isn't going to continue, then
Correct.
those assets become worth a lot less. And I suppose one of the problems you've got with cruise ships is who's in the market to buy cruise ships.
Exactly.
So they end up
in
being
large quantities.
So they end up being repossessed by the banks, and the banks don't know what to do with them. And it must be quite difficult to repurpose a cruise ship. So I suppose you've got the Queen Elizabeth II that's now a major hotel somewhere.
Yeah.
So I suppose you still got some ideas. I mean, they're not totally wasted, but that asset, that value in the balance sheet becomes a lot less. I mean, something only. I mean, everything's got a value, but it's not necessarily the value you want.
No.
And this is. I mean, you were telling me what's going to happen at the Trafford Centre, for instance, which is that massive department store block. You know, how many shops are actually in the Trafford Centre?
Oh, I guess it must be in the hundreds, mustn't it?
I'd have thought even more, you know. So what's going to happen there? Because at least with that's an asset that you can repurpose.
Well, you might not even need to repurpose it. It's just that the owners at the moment of those particular assets, they're probably going to go out of business.
Yeah.
But then those assets will be purchased by another company at a much lower value that's in the books of the current owners.
So who takes the loss?
Well, it'll mainly be the shareholders, I would imagine.
Right. So it's a case of, it's a phoenix, isn't it? It's a posh phoenix. It's a big business phoenix where the old company dies, all the assets are wiped and gone, and new people, possibly with some of the same board members, come along and they buy the shares, or they set up a new company, buy the assets for quarters of the pound, and they're away again. And it's the shareholders and the suppliers.
And the banks, obviously, whoever's lending them money.
Yeah. Do we care about the banks?
Well, that's a different question, isn't
it? Yeah, but the point is, people will have lost lots of money there, but the business itself, the operation of the Trafford Centre will continue with a new wave of investors that have bought out major assets at minor prices from the old shareholders and stakeholders, and it's off again. So, is it fair to say that a lot of these big firms are fairly bulletproof in the way they operate? I mean, are the shipping companies going to disappear? Are the cruise companies going to disappear?
Well, again, it's one of those things. The owners of any particular cruise liners, if they can't see through the pandemic and they go out of business, then like you said, the assets will be sold to somebody else, and the shareholders of the original company plus the banks will probably take the hit.
Yeah,
I would imagine.
And it's great. If you notice, every time there's some sort of great disaster or slump, when you've got lots of companies that are on the verge of bankruptcy anyway, or they're very underperforming, or they have some other problems going on, they suddenly start declaring bankruptcy, and yet they were in trouble before the actual crisis went on. So maybe.
Well, that has certainly happened in retail. There's a lot of retail. There's a few retailers and some restaurant chains who have been, due to the pandemic and not being able to trade, are actually filing or have been in the process of filing. But some of these were in trouble even before that time. I mean, I think Debenhams is one example where they've had to close some stores, but they were in trouble even before the pandemic.
They've been in trouble for donkey's years, haven't they?
Yeah.
Is it, some people have a strategy of, is it a bear market or looking for problems with companies to either invest in or sell shares in before they bought them and buy them back at a lower price later when it's dropped?
Well, a bear market is where a market is falling, has fallen by more than a certain amount. It's usually where the stock market has fallen more than a certain percentage. There's different valuations on that, and a bull market is where it's been moving upwards. So obviously if share prices fall, you might see that as an opportunity to go in and buy at a cheaper price, or alternatively you could go in and buy and if share price could keep falling, because no one knows where the bottom is of the market and no one knows where the top is.
It's all very uncertain, isn't it? It's almost like gambling.
I mean, people do compare it to gambling, and and it can be seen that way. But I think it depends how you approach it and what kind of investments you make. Because you do have to remember that you are actually buying shares in you are buying portions of businesses. So if you buy a portion of a business and it's a good business and you don't overpay for it, you're unlikely to lose your full stake like you would do if you were gambling.
Yeah. What about insider trading?
What about it?
How do you get into that? I've always found these things quite amusing. But people have always said to me, why they expect that I'm really into stocks and shares. I'm really not. And they say, why not? And I get tips all the time. Why, put some money into this company or that company. And my actual answer, and it's my belief, is that, well, I'll invest in my own business. Or I might invest in a business that I know about, or somebody that I know about. So you might come along and say, well, I'm going to restart Simon Rothman Consulting again.
Sure.
And I'm going to do this. And I might think, well, I've known Simon a long time. I know he's a fairly stable, steady person, and he sort of understands what he's doing. And you're certainly not a gambler. And I think, well, maybe I would invest in your business, but I'd certainly invest in my own businesses. I'm not a big fan of investing in, the market trends and what people think. And
I think it's always advisable to invest in your own business first.
Yeah.
Because you have more control over it. Yeah. And I would never advocate anything different. If you're a businessman or woman, I think the question then arises: if your business is successful and you have surplus profits, what do you then do with those profits? If you don't want to reinvest them in your business, say you don't want to expand your business, or you're drawing out a salary, and
I've got 3 daughters.
Well, I think most people, or certainly many people, they put money in the bank, in cash ISAs, in various other bank accounts, etc. The question is, if that's what you're going to do, the question is, can you beat those returns by investing it on the stock market? So if you're only at the moment 0.5% or less in a bank account, you might want to take the view that I'd rather try and beat this. I don't want to earn 0.5%. I want to earn 5% or 10%.
Yeah, and of course, if you can hit your money needs doing that, then it's a lot less hassle than running a business. So maybe a little bit of both.
Well, like I said, I would run your business, but then depending on your profits, the amount of profits you're taking out of that business, where you're then putting them after you've paid for your 3 daughters.
Yeah.
Where's that going? What are you doing with it? You're putting it in a bank? Are you buying a nice car?
I suppose don't invest with money you can't afford to lose. Is that?
They say that, but realistically, nobody can afford to lose it.
Yeah.
Can they? I mean, who can? Even wealthy people can't really afford to lose it. So I think that's a bit. I've heard that expression numerous times. I don't really agree with it. People can't really afford to lose it, but equally, they don't always want to sit with money in the bank that's only earning 0.5%.
I get it. So there's a lot to go at here, isn't there? But it's quite unknown. The stock market is a scary place for most people. So they often, if they do get involved in the stock market at all, or the commodities market, it's often a bit like betting on a horse, or they're just on a whim. They go
what you're doing, and you've got no knowledge about how it works and what you're doing, then essentially you are, and you might be lucky, but read a few books.
Yeah. Well, yeah. So what we're saying here is that we're better off investing in our own businesses and running our own businesses.
Yes, absolutely.
But if you do want to have a little, should we say flutter, or you want a little bit of fun?
I wouldn't use the word flutter, because
what would you say? Fun?
No, it's
interest.
Well, it might be interesting to you, but I would say if you're looking at diversifying your investment strategy, then you might want to look at that. I would certainly advise people just to be very careful, not to jump in. Try and learn as much as they can themselves. Because there's always a financial advisor out there wanting to make decisions for you, but it's not something I'm comfortable with.
Well, I'm interested because I listen to your calls and what you tell me, and I find it all very interesting. And even though I'm not investing in the market, just listening to you has actually opened up the door. And it probably means that if I do decide to make investments on the market, I'm probably a little bit more attuned to what's really going on. And it's all about making better and more informed decisions.
I think it's right. It's about informed decisions, and it's like if you realise you actually could lose a certain amount or make a certain amount, then at least you've got the knowledge going into it.
So we can look at businesses from an investment point of view, either stock market ones or your friend's new garage, or even your own business. Or we can make better decisions by following the trends of the stock market and let you take all the losses and tell everybody, oh, this is what I've done today, but this was what I should have done. Yeah, so I think there's also the possibility that because we do have connections within the city, that if somebody does have a good idea or does have a business that could potentially benefit from going down that route themselves and joining one of the stock markets, then let's talk about that as well. So you know where I am. It's contact@stephenenglander.co.uk, and if you do want to speak to Simon, just drop me a line and I'll put you straight onto Simon, and you can have a chat to your heart's content. In the meantime, keep well and happy investing.
Thank you. And you.
Thanks, Simon.
All right.